Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. And the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you guys got it. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Go back tomorrow and I'll lose it all. Should be fun.
Good afternoon. Oh, hey, my camera's not working. So we're just going to come to this view. No camera here for this. That's okay, because we're going to put, we'll put Jerome in the corner there anyways. But I had an interesting market here this morning. The treasuries are really going back and forth quite a bit. When we left, they were kind of on the up move. After we left, there was another little bit of a move further. So I could have made a little bit more on that, but I think in the end I lost $7 on the day. I'm probably not going to trade this unless there's something that's like really obvious to me. That I got to tell you, I'm always tempted to want to trade the Federal Reserve. I've done it a few times, and I've actually made some big money from doing it too. But this one in particular, man, is going to be a madhouse. Just the expectation of like that there will be a 50 basis point hike and all of that, and the way that the comments that they were making about 75 basis point hikes and some Fed members like countering that, but then us going into the blackout period before they were really done like talking about it. Right. So we have a Federal Reserve meeting with a lot of uncertainty attached to it because of that. Now, I don't think that when they release the announcement, it's almost certainly going to be 50 basis point hike. OK, there could be something in the statement about purchases. Right. And that could move them as well. But OK, are we back? Dude, I'm sorry about that. I don't know what the deal was with that. My internet has never died like that. And it was very curious timing, wasn't it? Just exactly before the statement and everything. Well, it looks like that so far the market is liking what it sees. They really came back there. If I'm actually kind of tempted to go short over here in the micro. I'm quite shocked that the market makers are putting that much on. So that's curious. I'm just gonna pull it over here. It looks like things are kind of still chugging around here, so I don't know if it would be a good idea for me to try and click in on something right now, but this sim trade worked out really well. This sim trade in the ES has really been working out. Remember I said 41.50? Yeah, that one's been great. I probably shouldn't put in any orders though, because what if my internet dies again? I don't know, that was weird. I reset my router and it looks like we're fine. So I don't know. That was weird. You guys still with me? Looks like we got viewers again, so I think we should be connected again. I probably need to refresh this page here. I don't think I'm getting chat. Refresh. Can't play. There we go. Yes. D says we're back. Okay. Yeah, I don't know what happened. My internet completely died. I reset my router and now it's fine. Look at that. I can't believe that they're giving me a 2-point spread. Okay, well, let's just come in here. Let's see what's in the statement what they're reading this. Okay, so they said Although overall economic and activity edged down in the first quarter, household spending and business fixed investment remain strong. In addition, COVID related lockdowns in China are likely to exacerbate supply chain disruptions. The committee is highly attentive to inflation risks. The committee decided to begin reducing its holdings of Treasury securities and agency debt and mortgage backed securities in June, first as described in the plans for reducing the size of the Federal Reserve's balance sheet that were issued in conjunction with this statement. Related information. Yeah. Okay. So then in that related statement, what was it? I don't see how much the balance sheet rejection was, but when reserve holdings are slightly over the level it considers to be compatible with enough reserves, the Fed aims to slow and then seize the fall in the size of the balance sheet. Okay. Fed policy vote was unanimous, so that might be why the market likes this. Missed the announcement. How much? It was a 50 basis point hike. So the market seems to be moving up. So one theory that we got here is that the interest rate decision was unanimous, and everybody is thinking that, okay, so right now for the June meeting, it says 77% for 50 basis point. So what we may be seeing is the market repricing the possibility of these 75 basis point hikes, which I always kind of said was likely. Is gold seems, oh yeah, that's a good observation there. Gold is definitely moving. Man, my yield change estimate's not being very effective today. In all of this, it's just changed too much from what the CME data that I get is. I'm gonna change all this. Yeah, I didn't see anything about the size of the balance sheet reduction, but that might also be a major factor here, right? Yes. Fund futures imply traders see 77% chance of Fed hiking 50 basis points at the June meeting, up from 56% before the May FOMC statement. So that seems to be the biggest change that we are seeing at the moment, at least in the treasuries. It's an aggressive bid showed up there at 14.5. Is that the market no longer believes that they're going to do 50 basis point hikes. Now, positioning here, if we wanted to go short the micros, is kind of tough. I mean, 996 is not bad. 3 would be cool. Nice even number, but it's a little, it's able to move. It's able to move around a lot. So the other thing is that, well, okay, so the S&P 500 is kind of fallen here. There wasn't that much of an acknowledgement in the statement about the weakening economy. It was very, very much in line with what we knew, that there's supply chain disruptions and things weakened in the first quarter, but the consumer still looks strong. So, well, that's interesting, Because they actually bid up there a little bit. Let's just reset it. But the micros here are a slight step higher. Yeah, that's interesting. The Federal Reserve is showing some pre-video now. Look at that. Well, I'm glad that I was able. If I had really been going here and everything, I would have probably taken off a lot more on this trade. But oh, I'm sure he will. But here's the thing. He's likely, in my opinion, he's likely to be more dovish. Yeah. I mean, I know that that's incredibly speculative. When did you increase your position? Well, so before I started the stream, I had started trying to build a position at 09.5 just for fun with a sim account. So I got 5 contracts long before the news, and then I took one off up here at like 18, I think. 17, 18, something like that. Maybe would have wished to have done more, but I don't know. If we come back down in here, I suppose I could do it again. But look, they're kind of coming back. Like there was a knee-jerk reaction for sure, but they're coming back. I'm sure some of that is liquidity holes and everything, but I don't know. And the S&P 500 is just, well, the S&P 500 took off and is already retraced back and is maybe starting to make its next move. But this is definitely like the environment we were expecting. You know, they can just go all over the place. So entirely possible that the treasuries push up and break the highs here. You know, like, hey, you want to go short 3? I don't like holding trades through the statement or through the press conference, though. That, especially taking trades within the press conference, that's usually not very fun. I do think we could make money from it here, though. I'm a little scared to do it, but it looks like that's coming down. Look at all of these people that are in the PR campaign for the Federal Reserve down here in the bottom. It's just regular everyday people explaining how the Federal Reserve works, folks. I don't know. I can't. I'm not hearing it at the moment. Let's see here. Interest rate futures suggest a 35% probability of a funds rate at 3 to 3.25 at year end versus 52% from before. So are they just overall? Well, look at that. Look at that. Vavoom. Well, I'm not going to touch it, but hey, they gave you opportunities to do it, didn't they? They gave you opportunities if you wanted to trade it, if you had the balls. Even with micro contracts. Quite impressive. If it's clear to everybody that the Fed funds rate should be 3% right now, then why pussyfoot around it? Just do it. That's what Volcker would have done. What would Volcker do? WWVD. Well, we're going to have to start asking ourselves that any time that we talk about the Federal Reserve now, right? What would Volcker do? That was a good pop, I gotta say. I can't explain what that's coming from. Really was just a really massive buy in the 10-year. Was primarily the 10-year. Can make a great short, yeah. Well, I might come back here, but maybe you could get 2.995 now. You got to be suspicious about moves like that. So there was no news attached to that. Why would you get such a sudden rush, right? That's again, when I see a really impulsive move these days, I'm immediately thinking stop run. So if it was immediately a stop run, then that kind of suggests to you that buying volume that came out, that's probably the end of that buying volume, right? Or at the very least, that you've got to worry about the liquidity hole behind you now dragging you back down through to let's say 16. So you don't want to see that and go, oh yeah, well, this is going to continue and hit into that. You don't want to do that one. Now 2.99, maybe okay there. I'm still really surprised that there's that much liquidity. Of course, it's terrible in the 5-year. Look how terrible it is in the 5-year. I don't see what you're talking about. All I see right now is still just a very slippery market, right? Yeah. Well, that's kind of like, doesn't look like they're going to slow down. And by the way, what is the spread doing? Is the spread steepening? It is steepening. Well, that's good though, because steepening spread, I like that. Seth likes the steepening spread is good for Seth's bank stocks. The S&P 500, I think, is kind of saying that Jerome Powell is going to have to come out and sweet talk them for them to really rally. What do we got? We got about 10 minutes left. So that's another thing is, do you really want to, like, if we had taken the trade at 3, let's say that I had been short at 3. I don't think that I'm clicked out, but I'm kind of sitting here thinking, I don't want to be in during the press conference. Maybe I should get out here. That's what I'm thinking. Well, that was a kind of an aggressive drop there. Okay. It's coming back again. See what I mean? I mean, this move originated back down at 14, so. Yeah, no need to bet profits on press conference. I'm really tempted, though. I mean, look, like the problem with the press conference is, number one, you have, everybody's sitting there getting the same piece of information at the same time. So there's not really any way for you to get an edge on that way. And number two is that sometimes the way that the market interprets those statements and stuff is really bizarre. There's a lot of like knee jerk reactions and like the market overreacting to what he said. It's just like one big trader thinks that's a big deal and trades it, and then that's what they go with, even though in the long run it doesn't mean anything. It happens often, so often, and so trading the presser is a very, very troublesome thing to try and do. But you can or rather, I think that there is a good chance that anything that he says is going to be dovish. I think there's a good chance that anything he says. How many lots is this? Can he close? Yeah. Well, do you think I should close some more? I probably should have closed some more when we were back up there at 19, huh? I'm kind of waiting for something to tell me that so something that confuses me is how is it that I have like 5 contracts on? Is it that did I have 5? Oh, I only have 2 on. I only have 2 on. I thought I had 5. Well, if I have 2, then let's take one off at 16. We'll see here. Might not get that fill. Yeah, making more come second. Yeah. Well, I think the reason why I want to reduce my size on this, I thought that I was like 5 long. So, um I would like to kind of market make it. So, if they give me, if they come back down into this area, I might start adding back up. But for now, one contract is enough. The S&P 500, I didn't really take anything off of that. I probably should have done that as well. But I had really reduced my size beforehand, so especially if they come back to like my entry area, I'm just going to be getting more long over there in MES. That 4150 is kind of my spot there. I have to say though, I'm really, really fighting the temptation to come in with a 1 lot and sell this micro here. Swaps losing faith in a 75 basis point hike in June, giving up on bets in the wake of the FOMC statements as source. Yeah, pretty big deal, but I could say I've definitely seen FOMCs that were worse, right? So far. But hey, we haven't gone through the presser, right? Yeah. So the bet is going to be, are 75 basis point hikes on the table still? Well, not what they're, of course they're on the table. They're going to say everything's on the table, but do they really want to do 75 basis points? Well, the bids seem to be holding okay here. Kind of wondering if 2.99 is just the best that you're going to get. I suppose though, with the treasury here at this point, I think I'm more interested in, do they continue to steepen? Okay, so we have got another impulsive move there. That one wasn't really attended by any volume in the treasuries. It might have been a currency move. I see you moving there, gold. You gonna move up, are you? Yes. I think that would be just lovely. 1900 again, could we do it? I just feel that gold has been, hammered too much. I think they need a break. Man, how do you see this? Okay. $17. So the 10-year actually ticked up a little bit there. But it's not really changing the rate. No. My estimate for the interest rate, though, is kind of evening back out. But look at this. So, like in the 5-year, see this huge spread? And it's likely that it's closer to, the real rate is closer to 3.023 than it is to 3.038. So that kind of makes you think that momentum is going to be up here a little bit and that the treasuries are going to fall back a little bit, or at least that's kind of what they're preparing themselves for. Coinbase opens its NFT marketplace to everyone. Yeah, that's like many months late though. Man, I've been seeing so much news and stuff lately this week about how the NFT market is collapsing. I don't know. Maybe that means there's a short-term bottom or something. I don't know. It's not the kind of headlines that you want in your Coinbase, right? I'm still not getting any kind of signs of like any kind of some sort of milestone that we could try and use as a reference here. It does look like maybe tilted slightly to the upside. Do you see the 5-year moved there a little bit more on the downside? Yeah, I mean, it's okay to like sim trade in this, but unless you feel really confident about a trade, it's usually best to stay out of this one. It's just in order to have like a good edge here, you have to be able to take on a lot of risk. Is kind of the problem. Like maybe here in the micros we could have gone short. Well, we could have gone short 3 and we could have made $15, right? But it could flip back the other way and you could be out $30 awfully quickly, here during the press conference. So, well, there's another little further move. The S&P 500 spiked there. Is he talking yet? It's 12:30, but they haven't started it. Maybe he is speaking and I'm just not. It's just not giving it. Oh yeah. Okay, but he hasn't come. Oh, they're having an actual in-person press conference this time. Okay, here he comes.
For the first time in a couple of years.
Yeah.
Before I go into the details of today's meeting, I'd like to take this opportunity to speak directly to the American people. Inflation is much too high.
See that?
We understand the hardship it has caused.
Oh, the first thing he says is inflation is too high.
To bring it back down. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by a half percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. After
He got out in time.
5.5% pace last year, overall economic activity.
You might have a gambling problem, son.
Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed, household spending and business fixed investment continued to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment
You hear this thing where it's like
7 million jobs.
my machine seems to be behind.
Post-pandemic and near 5.
Since we're in such a crazy market, let me come in here.
Improvements in labor market.
Well, my CPU's not pegged.
Including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and price pressures have spread to a broader range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating
I think I'm going to puke here.
On inflation.
At break even.
COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well. Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine.
Yeah, the E-mini is a little different for me. I think in the E-mini, let's hang on over there.
In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so.
I mean, you got out in time, but we really called the potential risks from trading that really well, didn't we?
By a half percentage point and stated that it anticipates that ongoing increases in the target range will be.
That's like the 04 half. That's the low.
The process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy.
But they hit back there. That's interesting.
We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving.
He said additional 50 basis point increases there, right?
Our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include.
Well, what you gotten right now is a market that's very sensitive to everything that he's saying. It's hard for me to sort out if this is net negative or positive now at this point.
The cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Goes word hunting. Well, it's people too. It's just, you just got to realize that markets are very inelastic. So anybody that wants to trade off of something that he says is going to move the market a lot.
6% in March is now essentially at the level that the committee had expected would prevail over the.
I love the tie, Timorous.
And at the bottom end,
that's a nice tie. You like that? It's a good color.
For the long
it matches his suit.
That you submitted in the projection.
It's all blue.
How has your outlook for further declines in the unemployment rate changed since March? What does this imply for your inflation forecast? And how has your level of confidence changed with regard to the feasibility of slowing hiring without pushing the economy into recession? Thanks.
Thank you. So you're right. 3.6% unemployment is just about as low as it's been in 50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional participation. So people will be coming back into the labor force. We've seen that, particularly among prime age people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation will slow. Job creation has been at more than 500,000 per month in recent months, very, very strong, particularly for this stage of the economy. And so we think with fiscal policy less supportive, with monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation. Implications for inflation, really the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time. And they are one good example of, or good illustration really, of how tight the labor market really is. The fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, of vacancy filling and things like that, and more people coming back in, we like to think that supply and demand will come back into balance and that therefore wage inflation will moderate.
We're going back and forth there at 10 quite a bit.
But ones that are more consistent with 2% inflation.
Look at that.
That's our expectation. Your third question was?
Your level of confidence that you can slow hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. There's a path by which we would be able to have demand moderate in the labor market.
Oh, there's a path.
And therefore have vacancies come down without unemployment going up. Because vacancies are at such an extraordinarily high level. They're 1.9 vacancies for every unemployed person, 11.5 million vacancies, 6 million unemployed people. So, and we haven't been in that place on the vacancy, sort of the vacancy unemployed curve, the beverage.
Well, they didn't give me much time
of a ratio
on that one
in the modern era. So in principle, it seems as though by moderating demand, we could see vacancies come down, and as a result, and they could come down fairly significantly, and I think put supply and demand at least closer together than they are, and that would give us a chance to have get inflation down, get wages down, and then get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome.
Softish.
I'll give you a couple reasons.
It's going to be a softish landing.
Households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets.
Softish is my new favorite word.
Larger than the prior trend. Businesses are in good financial shape. The labor market is, as I mentioned, very, very strong. And so it doesn't seem to be anywhere close to a downturn. Therefore, the economy is strong and is well positioned to handle tighter monetary policy. So, but I'll say, I do expect that this will be very challenging. It's not going to be easy, and it may well depend.
Well, 150 is not bad.
Not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You talked about using 50 basis point rate hikes or the possibility of them in coming meetings. Might there be something larger than 50? Is 75 a percentage point possible? And perhaps you could walk us through your calibration. Why 1 month or one meeting should we expect at 50? Why?
Maybe I should just
something smaller.
keep my
what is the reason
control over here?
The level of the amount of tightening. Thank you.
Sure. So 75 basis point in an increase is not something the committee is actively considering.
Not something we're actively considering.
50
Okay.
basis points today. And
I think that the feed that I'm getting from Utah is probably a little delayed.
financial conditions evolve in ways that are consistent with our expectations. There's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to
Next couple of meetings,
at the meetings, of course,
but not
we'll
75s.
be paying close attention to the incoming data and the evolving outlook, as well as to financial conditions. And finally, of course, we will be communicating.
Go,
to the
ES,
public
go,
about what our
go,
expectations
yes.
will be as they evolve. So the test is really just, as I laid it out, economic and financial conditions evolving broadly in line with expectations. And,
Oh,
think
I have to
expectations are
submit my
that
timesheets.
we'll start to see inflation
How many am I missing?
flattening out. And
3. Okay.
not necessarily declining yet, but we'll see more.
That's not
we'll see
that
some
bad for me.
evidence that the core PCE inflation is perhaps either reaching a peak or flattening out. We'll want to know more than just some evidence. We'll want to really feel like we're making some progress there. But I mean, we're going to
Want a short 3 again?
There'll be a lot more information. I just think
It's feeling a lot better now, doesn't it?
we get there. It's a very difficult environment to
I don't know.
try to give forward guidance 60, 90 days in advance. There are just so many things that can happen in the economy and around the world. So, we're leaving ourselves room to look at the data and make a decision as we get there.
I'm sorry, but if inflation is lower 1 month and
What the heck?
higher, would that be something that we would calibrate towards a lower increase in the funds rate, or
I don't think
if
a
those are-
1 month is not, no. 1 month's reading doesn't tell us much. We'd want to see evidence that inflation is moving in a direction that.
Look at this picture
As I said, we've got 2 months now.
from
where
Forex Live.
is a little, but we're not looking at that as a reason to take some comfort. I think we need to really see
It's a relatively good Photoshop too.
being fulfilled. Inflation, in fact, is under control. And
Saving that one.
but
Or no, wait. We'll just save it in Discord.
it's not like we would stop. We would just go back to 25 basis point increases. It'll be a judgment call when these meetings arrive. But our expectation is if we see what we expect to see, then we would have 50.
The guy who asked that question is long, I'm certain. No, I think the other people were kind of trying to tease that out of him, but he just asked it directly.
Given the expectation that inflation will remain well above the Fed's target at year end, what constitutes a neutral
18,
policy
18.5.
setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to move beyond that level at some point this year?
So, neutral. When we talk about the neutral rate, we're really talking about the rate that neither pushes economic activity higher nor slows it down. So it's a concept, really. It's not something we can identify with any precision. So we estimate it.
Look at that.
Broad bands of uncertainty, and the current estimates on
Ooh,
are sort of 2 to 3.
effing yeah.
So that's a longer run estimate. That's an estimate for an economy that's at full employment and 2% inflation. So really what we're doing is we're raising rates expeditiously to what we see as the broad range of plausible levels of neutral. But we know that there's not a bright line drawn on the road that tells us when we get there. So we're going to be looking at financial conditions, right? Our policy affects financial conditions and financial.
My E-mini long is happy.
So we're going to be looking at the effect of our policy moves on financial conditions. Are they?
Oh, you can't see me. The camera's not on. I'm clapping.
Effects on the economy, and we're going to be making a
I
judgment.
like it.
about whether
I
we
like what I'm seeing.
to get us on a.
Should have been more aggressive back here. Oh, well.
It's that. So, if that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision in the discussion that we as policymakers don't really feel. You're going to raise rates and you're going to be.
I'm a little surprised that the market is reacting this strongly to him smacking down the 75 basis point hike. Mostly because, I was saying 2 weeks ago that it probably wasn't going to happen. Well, or at least that it's not as likely as the market thinks it is because the other FOMC members were pushing back.
Do you see evidence that inflationary psychology is changing, that in areas like workers' wage demands, businesses' willingness to
We could have gone short at the 3. Should have done it. Should have done it. $30. Oh well. You know what? I don't think that I want to take trades because my DOM is kind of lagging here.
Yet, but that does not in any way make us comfortable. I think if you look at
Ooh, look at our go.
expectations, they're
She's
quite
going.
elevated. And you can look at that and say, well, that's because people expect inflation to come down. And in fact, inflation expectations come down fairly sharply. Longer.
Okay, so they broke that move up only breaks yesterday's high, and that previous day's high was 119.020.
So
above that.
look at that, and I think that's
So
a fair description of
if you have any questions about could this go further,
the risks. We don't see a wage price spiral. We see that companies have the ability.
yours is lagging as well. Are you using the Jigsaw Bridge?
So I just think
Kind of wondering because I don't remember getting this behavior when it was.
we know
Oh,
we
what
need
the
to
heck!
expeditiously move our
See how
policy
dangerous this is to trade.
range of more normal, neutral levels, and we need to look around and keep going. If if we don't see
I'll take one.
financial conditions have tightened adequately, or that the economy is behaving in ways that suggest that we're not where we need to be. So you don't see those things yet, but I would say there's no basis for feeling comfortable about that. It's a risk that we simply can't run that risk. We can't allow a wage price spiral to happen, and we can't allow inflation expectations to become unanchored. It's just something that we can't allow to happen, and so we'll look at it that way.
Gina.
Look at that. Big order trying to chase it.
Great. Thanks, Chair Powell. Gina Smilik with the New York Times. You mentioned in the statement both the upside risks to inflation from Russia and China. Obviously, those are very much supply shocks rather than demand side. And I wonder what you meant to convey by adding them. I wonder what you meant to convey by adding those.
Well, so our tools don't really work on supply shocks. Our tools work on demand. And to the extent we can't affect really oil prices or other commodity prices or food prices and things like that. So we can't affect those. But there's a job to do on demand. And that you can see that in the labor market, where demand is substantially in excess of supply.
It's a dovish 50 basis point hike. Yep. Isn't this what I said it was going to be? I feel like I called this one perfect.
The situation in Ukraine and the situation.
I wish that when we had that initial down move that I had the balls to be like, okay,
And people are going to be
double down.
That,
No, I would never do that.
almost suffer.
I think we still played it within a good risk parameter here in the Treasury.
But even though they don't actually tell us much about the future path. So, but the second thing is that they're both capable of preventing further progress in supply chain, in supply chains healing. And so, or even making supply chains temporarily worse. So they're not.
I'm gonna take it right there.
To weigh on the process of global supply chain healing, which is going to affect broader inflation too. So in a way, they're two further negative shocks.
It went up when he said strong and effective. Just to realize, I'm pretty sure that the stream that we're getting from the YouTube live stream is delayed by like a good 5 seconds or so.
Hi, Victoria Guida from Politico. I want to follow up on that because you all have obviously highlighted that there are both supply and demand issues at play in inflation. And I'm just wondering, if these supply chain issues continue because of Russia, because of China, or just because these things take a while to work out, does getting back down to your 2% mandate require that these supply chain issues get resolved, since you can only handle the demand side, as you said, or will you have to crimp demand maybe even further if the supply chain issues don't resolve themselves in order to try and get inflation back down?
Dollar is getting destroyed.
We're focused on doing the job we need to do.
I'm actually, you know what?
Be done there. Again, if you look at it, it's essentially almost two.
This is a crazy thing, but I'm thinking long Bitcoin here. 39.44, 39.445.
Employed plus
long Bitcoin.
Than there are the size of the labor force. So there's
because
an imbalance
they're gonna try and sweep back across that 40K,
our work on.
and the market is very much reacting to this is dovish,
which would
right?
include
So
the commodity price shocks.
you earned your keep as a juice maker.
That's one of the reasons we would tend to focus.
I think I did a pretty good job.
We
Thanks.
can have more of an effect on that, but would be a very difficult.
Obviously, could have been
we have
more
to
aggressive at
ensure
points,
that
but
inflation expectations remain anchored.
I'm keeping the 2 on right here, right?
That's part of our job too. So we'd be
That's a break of the previous day's high, right?
It's,
Oh, not
any
quite.
Central bank in a very difficult.
02.
Howard Schneider with Reuters, and thanks, and nice to be back. So 2 questions, one quick one. You cited the 1.9 to 1 figure so often now. I got to ask you, what would be a good figure there? What would you like to see that?
Kind of wondering if the market can't go all the way back to 120.
And secondly, on
Maybe not today, but like by the end of the week.
counting on wealth,
Possible, especially if
markets broadly down quite.
the jobs report on Friday is bad.
How are you mapping that into household consumption? Have they come down?
ETH just broke any daily TL and sets up will for AI. I think you go long here.
Stop spending at the rate you need them to stop spending?
Okay, so in terms of the vacancies to unemployment ratio,
Big orders somebody
we don't have a
placed
goal in
there.
mind. There's no specific number that we're saying we got to get to that. It's really you've got to get to a place where the labor market appears to be more in balance. And that depends not only on the level of those things, it depends on how well the matching function in the labor markets are working, because the longer these expansions go on, you can get very efficient with all of that, and the beverage curve shifts out, and that also tends to.
Look, that looks like they're just going to blow right through 119.
So there isn't a specific number. I will say we were at, I think when we got to 1-to-1 in the late teens, we thought that was a pretty good number. But again, we're not shooting for any particular number. What we'd like to see is progress, but we're not really looking at that. That's an intermediate variable. We're looking at wages, and we're looking at ultimately inflation. So there are a bunch of channels through which policy works. You can think of it as interest-sensitive spending, and then you can think of another big one as asset values broadly. And there are big models with a lot of different channels that are related to that. We don't focus on any one market, the equity market or the housing market, or.
Is that actually kind of continuing through here a little bit more quickly than I thought?
Any one market, as you suggest, for going up or down, or taking a view on whether it's at a good level or a bad level. We just would be looking at very broad measures of financial conditions, all the different financial conditions indexes, for example, which include equity, but they also include debt and many other.
This has been a $50 move here in the Treasury, and it's probably not done.
Rachel.
Hi, Chair Powell. Rachel Siegel here from the Washington Post. To follow up from your message from the very beginning, what is your message to the American people about when they will start to feel the effects of, say, a 50 basis point rate hikes or multiple hikes? How do you explain to them what it does to their grocery bill or their rent or their gas bill? Thank you.
So the first thing to say is that we understand, and some of us are old enough to have lived through high inflation. Many aren't, but it's very unpleasant.
Did he just call himself old?
When they experience it for the first time, you're paying more for the same thing. If you're a normal economic person, then you're probably don't have that much extra, to spend, and it's immediately hitting your spending on groceries, on gasoline, on energy, things like that. So we understand the pain involved. So how do you get out of that? And it's our job to make sure that inflation of that unpleasant high nature doesn't get entrenched in the economy. That's what we're here for. One of the main things we're here for. Perhaps the most fundamental thing we're here for. And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less stress and inflation will go down. Now, the process of getting there involves higher rates. So higher mortgage rates, higher borrowing rates, and things like that. So it's not going to be pleasant either. But in the end, everyone is better off. Everyone, particularly people on fixed incomes and at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can. We think we have a good chance to do it without significant increase in unemployment or really sharp slowdown.
Man, look at the 5-year is just a zoo.
Longer term,
holy crap!
Better off if we can get this job done. The sooner, the better.
Thank you, Edward.
Thank you, Chair Powell. Edward Lawrence with the Fox Business Network. So you've talked in the past about consumer spending and how that's drives the economy. Are you concerned with this high level of inflation that the consumer will stop spending, pushing us into, and what's the level of your concern, pushing us into a recession?
So the economy is doing fairly well. We expect growth to be solid this year, and we see household spending and business investment as fairly strong, even in the first quarter, which was relatively slow on some other fronts. And the labor market. If you look at the
seen that 3K right there at 04.5.
People who are out of work and looking, there are lots of job opportunities.
You see that 30-year is lagging there a little bit. We're getting like very, very, very strong steepening on this move.
A worker looking to either change jobs or get a wage increase in your current job. So it's a strong economy, and nothing about it suggests that it's close to or vulnerable to a recession. Now, of course, given events around the world and fading fiscal policy effects and higher rates, you could see some slower economic activity. Certainly it will not be. Last year was an extraordinarily strong growth year as we recovered from the pandemic. As I mentioned, growth over 5%, but most forecasters have growth this year at a
what?
above 2%.
What? You see that?
Economists who have advised
Oh,
Democrats
it's
and
too slow.
presidents, who both said that
Too slow.
the Fed is so far behind the curve.
It's all over the place.
And a recession is inevitable.
So, and as I said, I think we have a good chance to restore.
Well, I disagree with them, but I don't really have a very good argument for why.
A severe downturn without materially higher unemployment, and I mentioned the reasons for that. So I see.
He did mention reasons.
Very strong labor market, for example. Businesses can't find the people to hire. They can't find them. So typically in a recession, you would have unemployment. Now you have surplus demand. So there should be room, in principle, to reduce that surplus demand without putting people out of work. The issue will come that we don't have precision surgical tools. We have essentially interest rates, the balance sheet, guidance. They're
I think it's going higher.
Tools. They're not capable of surgical.
Short 9293.
I would agree. No one thinks this will be easy.
No, maybe not.
No one thinks it's straightforward.
You probably don't want to hit into it here
And
on any of these. Like the pullbacks are just too deep.
Our job is,
And they're probably vulnerable to a pretty deep pullback here at the moment.
achieve it. So that's what we're doing. There are a range of opinions, though, and that's only appropriate.
There are a range of opinions.
Thanks, Steve Dorsey, CBS. You mentioned earlier just now fading fiscal policy. Do you feel
I'll hate you.
the Fed has been supported enough from policies at the White House and in Congress in combating inflation?
It's really the Fed that has responsibility for price stability, and we take whatever arrives at the Fed in terms of fiscal activity. We take it as a given. We don't evaluate it. We don't. It's not our job, really. We don't have an oversight function there. And we look at it as our job given all the factors that are happening, to try to sustain maximum employment and price stability. So if the Congress or the administration has ways to help with inflation, I would encourage that, but I'm not going to get into making recommendations or anything like that. It's really not our role. We need to stay in our lane and do our job. When we
got short on ZF? Are you nuts?
Then maybe I can,
I think you're crazy. If you actually took that trade,
just focus on.
Then you're crazy.
I'll stick to that. Stick to that line.
Steve Matthews.
Steve Matthews with Bloomberg News. A number of your colleagues have said that rates will need to go above neutral into a restrictive territory to bring down inflation. One, do you agree with that? And two, you recently spoke in great praise of Paul Volcker, who had the courage to bring inflation down with recessions in the 1980s. And while it's certainly not your desire, and the soft landing is the big hope of everyone, would this FOMC have the courage to endure recessions to bring inflation down if that were the only way necessary?
So I think it's certainly possible that we'll need to move policy to levels that we see as restrictive as opposed to just neutral. We can't know that today.
He doesn't want to say, yes, we're willing to create a recession. He wouldn't say that.
I'll say again, there's no bright line, that you're stepping over. You're really looking at what our policy stance is and what the market is forecasting for it. You're looking at financial conditions and how that's affecting the economy and making a judgment. We won't be arguing about whose model of the neutral rate is better than the other one. It's much more about a practical application of our policy tools. And we're absolutely prepared to do that. Wouldn't hesitate if that's what is taken. So I am, of course, who isn't an admirer of Paul Volcker? I shouldn't be singled out in this respect, but I and have tremendous admiration for him. And I would phrase
I missed it. I tried taking it.
Do what he thought was the right thing.
I tried taking it, but somebody hit the order just before I did, and then I chickened out.
Was that he always did what he thought was the right thing. If you read his last autobiography, that really comes through. So that's the test. It isn't will we do one particular thing. I would say We do see, though, restoring price stability as absolutely essential for the country in coming years. Without price stability, the economy doesn't work for anybody, really. And so it's really essential, particularly for the labor market. If you think about it, if you look at the last cycle, we had a very, very longest.
The thing I like the most about Jerome Powell is he understands why he's there. He understands the mission. He believes in the mission.
You had the benefits.
He really does care about helping average people. I think all this junk people say about,
racial wealth and
Federal Reserve,
income gaps.
how it's bad for you
Coming
is
down, wage gaps.
nonsense.
It's a really great thing. We'd all love to get back to that place. But to get back to anything like that place, you need price stability. So we've been hit by historically large inflationary shocks since the pandemic. This isn't anything like regular business. We have a pandemic. We have the highest unemployment, since the Depression. Then we have this outsized response from fiscal policy and monetary policy. Then we have inflation.
Outsized response. Oh, so you're admitting you overdid it.
Cutting the commodity
You're admitting they're over
in half. And now we have these shutdowns in China. So it's been a series of.
It's okay. I think they're allowed to make mistakes.
From anything people have seen
Are they?
in 40 years. So we have to look.
You sent me the picture.
And look at the economy.
Oh man, you're crazy.
And we need to somehow find price stability out of this. And it's obviously going to be very challenging, I think, because you do have, numerous supply shocks, which are famously difficult to deal with. So I guess that's how I think about it.
Hey, Chris.
Oh, you took them on your live account too. You're nuts, dude. You're nuts. Have you made money overall today, though?
Earlier, you just said that if necessary.
This is too ballsy for me, man. I would never.
If it turned out to be necessary.
Like the trend is up. I'm not selling it. Hell no.
Restrictive levels.
This is something that could just keep going on the whole session.
The economy is, or certainly the hot labor market as you described it. Why still the hesitation?
You went short? You're crazy. You're crazy.
What else do you need to see in order to determine that? Wouldn't the Fed naturally be looking to go to a restrictive level at this point?
Okay, but he hasn't made money. Okay.
Sorry, I meant to say appropriate. We're not going to be erecting a high barrier for this. It's more if we think it's appropriate.
Look at that.
The point is we're very long way from neutral now. We're moving there expeditiously, and we'll continue to do so. And we can't make that decision really today about how high to go. We'll be on the table to be made when we reach neutral. And, I expect we'll get there expeditiously, as I've mentioned. So it's not that we're not.
There's definitely some support in the 119 area, but.
But I'll say again, if we do believe that it's appropriate to go to those levels, we won't hesitate.
Okay.
Mike McKee from Bloomberg Television and Radio. The balance sheet, why did you decide to wait until June 1st to begin letting securities roll off and not immediately start in the middle of this month, say? And do you have a newer or a better estimate for the monetary policy impact of letting the balance sheet decline? And then finally, I'm just curious why you felt the need to address the American people at the top of your remarks. Are you concerned about Fed credibility?
You're just trying to test the indicators. I would think you would do it with a SIM account, though, bro.
Pick a date. That happened to be the date that we picked. It was nothing magic.
Man, it's another good fill there.
It's not going to have any macroeconomic significance over time. We just picked that. Sometimes we publish these calendars on the first day of the month, and that's what we're doing. I wouldn't read anything into it. In terms of the effect, I mean, I would just stress how uncertain.
Okay, that's interesting because I thought that it was a significant thing. So, I really would have liked to have caught 295, but it just wasn't.
And make estimates of what will be the how.
I'm way too of a scaredy cat. Like here's the thing is I'm like making fun of D here because he's way too aggressive and doing crazy things. I should have done some crazy things in here. I would have made money.
Can't be any clearer. There won't be any clearer. People estimate that that broadly on the path we're on, and this.
No FOMOing in here though. But if it gets to this other side, I need to have the boss.
One rate increase over the course of a year at this pace, but I would just say with very wide uncertainty bands, very wide. We don't really know. There are other estimates that are much smaller than that, by the way, and some of you may have read about that. That's kind of a mainstream estimate. We know that it is part of returning to more normal, more neutral financial conditions. And our strategy is to set up a plan and have it operate, and really have the interest rate be the active tool of monetary policy. In terms of speaking to the American people, I feel like sometimes I want to remind us really that that's who we work for, and that it's inflation that people are feeling all over the country, and it's very important that they know that we know how painful it is, and that we are working hard on fixing it. I thought it was quite important to do that, and so that was really the thinking behind that.
Do you think the Fed has a credibility problem?
No, I don't. And a good example of why would be that
I'm sure that the level 2 indicators are just all over the place.
we started talking about tapering sooner and then raising rates this year. You saw financial markets reacting, very appropriately. Not to bless any particular day's measure, but the way financial markets, the forward rate curve has tightened in response to our guidance and our actions, really amplifies.
So he's happy
policy
with the way that the market's reacting.
Monetary policy is working through expectations now to a very large extent. We've only done 2 rate increases, but if you look at financial conditions, the 2-year is at 280 now. In September, I think it was at 20 basis points.
Yeah.
All through the economy, people are feeling those higher rates already, and that shows that the markets think that our forward guidance is credible, and I think that's we want to keep it.
Easy questions, it seems. All the questions that they're asking are just all of the questions that anybody that's following interest rate policy should have right now.
Hi there. Brian Chung with Yahoo Finance. To expand on Steve's question about Paul Volcker, there was also a great pain that came with that as well. Higher interest rates obviously affecting households and businesses, and wondering how you kind of square what might be demand destruction. Are you already seeing that? Is the idea here to incentivize a lack of spending, to decrease consumption?
I feel so left out.
Business investments, is that essentially
so left out
this hiking cycle?
I wish that I was short 9.5.
You can see places where their demand is substantially.
Actually, I wish I was short 3. I had a chance to go short 3 too, and I was too chicken to do it.
And at unsustainable levels that are not consistent with 2%.
And now I'm like, let's short 9.25. Yeah.
As we raise interest rates, demand moderates and it moves down. Interest rates, businesses will invest a little bit less, consumers will spend a little bit less. That's how it works. But ultimately, getting supply and demand back in balance is what gives us 2% inflation, which is what gives the economy a footing where people can lead successful economic lives and not worry about inflation.
Repeat those numbers. Well, I had a chance to go short at 3.
Pain associated with getting
3%.
The big pain is in.
But I was like, there's no way I'm going to trade this. And then over here, I was really seriously thinking about it at 2.95, and I even clicked in at one point, but I didn't get filled.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could take a step back and talk about, in March, the dot plot had looked like steady quarter-point rate hikes, get the funds rate up to 2% at the end of the year. Now, it seems like you're much more aggressive. So could you talk about the thinking that's behind that? Thank you.
So, look, I think what you've seen is really, I would say, last fall, in the middle of last fall, there was a time when our policy stance was still pretty much in sync with what the data were saying. If you remember, there were a couple of weak jobs reports, and inflation had actually month by month, inflation had come down till September, a few months in a row, stayed low. And then around the end of October, we got 3 or 4 really strong readings that just said, no, this is a much stronger economy. And by the way, then with the restatement of the jobs numbers, it looked like the job market was much more even and stronger in the second half of the year, but that hadn't happened yet. Anyway, we got an ECI reading employment compensation index reading the Friday before the November meeting. Then we got a really strong jobs report. Then we got a really high CPI report. And so I think it became clear to the committee that we needed to adjust and adapt. And we have. Ever since then, really ever since then, we've been adapting. The committee moved by the time of the December meeting to a meeting of 3 rate increases, then to a meeting of 7 rate increases at the March meeting. And that process is going on, and it's clearly continuing. And that's why I say, and I actually mentioned this at the March meeting, that no one should look at any single SEP as sort of a real resting place for 90 days, because we're in a fast evolving situation, and that's what's happened. You can see, unanimous vote today, of course, and I told you the guidance.
Why don't you only trade
on
this?
the committee.
How often does this happen?
Have 50 basis point hikes on the table at the next couple of meetings. So you're right. And by the way, other forecasters have been doing the same thing.
And there's problems with trading this.
Adapting to the data and to the situation, and using our tools to deal with it.
Thanks. We'll go to Nancy for the last question.
Yeah. Yeah, but I took on risk to do it.
Marketplace. Chair Powell, I want to ask how you're able to balance your dual mandate, stable prices and maximum employment, especially when the unemployment rate for black workers is still roughly twice the rate for white workers.
So unemployment rates for all racial groups have come down a lot and are now much closer to where they were before the pandemic.
Maybe they'll give me another chance.
So that's one thing I would say.
Yeah, there's problems in trading everything, yeah.
But the
trading's hard.
I do not at this time see the two sides of the mandate as in tension. I don't, because you can see that the labor market is out of balance. You can see that there's a labor shortage.
Really?
There aren't enough people to fill these job openings, and companies can't hire, and wages are moving up at levels that would not over time be consistent with 2% inflation over time. And of course, everyone loves to see wages go up.
I take
level, because
I told them that I'd be back at 2.
Being eaten up by inflation.
So we can stick around until the
to get the
market
kind of
closes.
labor market we really want to get. We really want to have a labor market that serves all Americans, especially the people in the lower
what are you talking about, G95?
part of the distribution, especially them. To do that, you've got
you were talking about the
got to get back to price stability
minorities.
so that we can have a labor market where people's wages
The question
aren't being
that he's being asked.
Inflation.
About minority
You can have
unemployment.
a long expansion too. That's the good thing, is you can have, as we have. We've had several of the longest expansions in U.S. history have been in the last 40 years, and that's because it's been a time of low inflation. And long expansions are good for people and good for the labor market. So that's the way I think about it. I think we, our tools work. We have to think in the medium and longer term, and I do think that the best thing for everyone is for us to get back to price stability to support really a sustained period of strong labor market conditions. Thanks very much.
Oh, that was the last question? Okay. So now that the big risk event is through, do they continue through here or not? So it looks like for the time being that some people have lost interest. So of course, as soon as I decide to try and do something is when it starts going. Pew, pew, pew. Move this back over to here. Let's just take, let's take 5 off there. I can't believe it came all the way back to 296, huh? Well, it could be some people are probably thinking take profits there and stuff. There was, oh, by the way, I don't really remember seeing anything. Oh, actually, yeah, the top was right at the pit close. Okay. Well, I wish I had realized that earlier. There's still a chance that we float back up here, but it's coming back awfully hard, isn't it? Still think it's an easy trade? Yeah. You got a free Billie Eilish poster, so you're a big fan now? What? What the hell, dude? Oh, man. I'm quite shocked that price um fell so catastrophically. It wasn't like I didn't think that 119 could fail, because I mean it was kind of had been support here for a little bit, but that far was like what, 22 ticks down? Come on. Come on, man. You're killing me here. Yeah, one time I got a huge painting of Bush reading to the kids and I put it in my dorm. Where would you get something like that? I'm surprised that something like that exists. Who would buy a poster like that? Oh man. Oh man. Okay, so there's a little bit of hope. Somebody started pushing back up. Did you take it? What do you mean? Did you take it south? No. I'm trying in my sim trade here. I'm trying to build a position. Still trying to improve my position. I'd say it's not going so well. I don't know. There was a push there, but look, it's kind of sputtered out. It didn't really actually turn. Oh, I mentioned something at 119. Well, so 119 was kind of like, there was an area where they had a hard time pushing below. And it just, so I guess you could consider it support, but that's where I was kind of saying, okay, well, we're on the end of the range that we wanted. Maybe we will get the trade that we wanted in the end after all. And it just did not work very well at all, did it? I mean, this might still turn, and who knows? By the end of the session, we might find ourselves up at the highs in the 10-year very easily. But that one particular swing, I called dead wrong. Joe was just dead wrong on. So it happens. I think in the midterm, depending on how the jobs number on Friday goes, that we could see ourselves back at 120 even in the 10-year, or maybe back towards like 2.75 interest rate, something like that. Well, the E-mini seems to be taking it in stride, and it looks like they are going to try and make a good run here into the close. We'll see. We'll see, but right now 4270 is looking pretty good. And I think that they've got a good shot at the highs, and that the S&P 500 could close higher from here. I think that they will want to buy into the close. We get up to 4280. It was kind of the prices from April 29th, so like last week. Big down, though that was kind of like the really ugly down move that we had last week, right? That they could wash that out. Could be positive. I'm wondering, the treasury just fell 4 ticks again there. I'm wondering if the S&P 500 turning so bullish is kind of causing the treasuries to push back a little bit. I don't know, man, that's pretty weak. That move down might have just been, like one guy comes in and sells 500 contracts and moves it down 4 prices. That's the kind of stuff that's moving us right now. So I don't think that I have to worry about it too much, but it was just very disappointing. Well, and then they buy it up 28 and it doesn't hold. Okay, well, that was a little bit better of an uptick, especially in the 5-year. Yep, and some iceberging on the bid. It's always a little when you watch it, the S&P 500 is particular loves to do this. It's like it's coming up, it's slow, and then kind of turns back down, and then right. You've seen those? ES loves to do that. Every time that happens, I'm always thinking in my head, oh, probably all these algorithms giving up. I don't know, guy. It's not really cooperating. Okay, that's better. Especially in the 5-year is again dragging us. So if we do get another move up, is it going to be attended by even more steepening? That would be lovely. Now, the 10-year is not coming along with it, though. Do I trade? Why would I trade Tesla calls? I'm not. Do I look crazy to you? I don't understand what it is that people come in and they see a guy trading micro treasury contracts and stressing over $5 because he cares so much about getting the good trade, and then think that he's going to go and play Tesla calls. Actually, I do have some calls in something right now, but it's not Tesla. I do have calls in something right now. They're not doing very well. They were doing really great at the beginning, and now they're not doing so well. But hey, you know what? They got 3 weeks. This is a pretty good day. I'm feeling positive about those. Hey, that was a good move up there in the 10-year. They kind of came along in the end, and the 30-year is lagging, but the 30-year might come too. Yeah. Maybe this isn't so bad. Maybe this isn't so bad. Or are you new? That's okay. So that's the first thing that you come in and say to people is it ask about. So is that a serious question that you really think Tesla calls this a thing to trade and that's what you want to watch? Or were you joking with me? Because I mean, Tesla options probably are fun, but I don't kind of have that kind of money to blow on day trading. Sounds fun though. Yes. Okay. Well, we could go pull them up. Nah, yeah. You know, even what we're doing here can help you even with something like trading Tesla options because the way that the index moves has a lot to do with the way that the individual components move, right? And the larger concepts about how we trade are always going to be relevant no matter what you're trading. You purchased some calls, man. How much money did you put on them? Because aren't the Tesla calls like $8,000 a pop right now? They're inexpensive. ... Well, maybe relatively speaking. Well, if you bought Tesla calls today, then good on you. That's probably a good. That could end up being a very lucrative trade in this particular situation, huh? So I keep having to recenter here in the treasury because it's just steepening so much, especially between the 5 and the 10. Look at E-mini go. So they are now above those highs. So the next step up is like 4,300. And where was it? Oh, okay. Yeah, it was way back there. So just remember, 4,300 is the top end of this range in the S&P 500 per se. It was 4,500 where we like faltered and fell down. Oh, 1,700. Okay. No, they're not $10. Well, but that's still $1,000 a pop, right? They're $1,000 a pop. I guess that maybe that is good. Maybe that is good price. Here's back to 1900. Should I try and move my target up a little bit? I'm kind of thinking maybe I should. Like I could do O2 right there. Or no, I'll leave it there at O2 and I'll move it down if I feel like. Oh, okay. So if you purchased it at 835, then that's real good. If you purchased it at 835 and it's $10 right now, then you're in the money. $119 even. Not big volume traded there, so it doesn't seem like they care too much about it. I guess since it's been touched so many times already, it's probably, kind of a math price. No, I didn't risk one ES contract. I traded up to 10 on that, I think. No, it was, let's see here. Where did I get in? Oh, I took so many sim trades today. It's embarrassing, dude. Okay, so I've traded 20 contracts. So I started with 5. I added 15 at one point and then took them off and took the plus, and then have just left the +5 on. But you're right, it's almost to 5K. I think that's the biggest sim trade I've ever done. Oh yeah, cool. We got our orders filled at 02. That was quite quick. Oh, this could be fun. I mean, so let's be careful here because the treasuries could collapse back down, especially since that last little move up was a little bit impulsive. But it doesn't get much higher here before like some people that were maybe thinking that it was over start panicking, right? If this were to go up into a new high, I think that we could have some fun here in the treasury. I hope it does. I hope that sounds like maximum entertainment value, don't you think so? Maximum entertainment value would be that for the 10-year treasury to get above 119.06. The ES has already come through. I don't know if it's appropriate for me to ask more of the E-mini. I just leave that one on until the close. Hope that there isn't like a take profit, drop and take profits towards the end. But here in the 10-year, they're like way past. Well, so where do we get to? Okay. So they got all the way up to 119.20 half in the 10-year before you get to like stops. From the market maker positions, that is. What does that put me at? What was the earlier trade day? Oh, it was at 3,000. I don't know how I did that. That was an ugly one. So that should be my goal on this treasury here, right? The offer's really leading the direction. Well, you're saying that they're pulling off a lot, yeah? I don't know. So one of the things that I think can make this kind of action a little bit easier to trade. I mean, the issue is it's actually easier to see what it's going to do and make a good bet, but you have to take on a lot of risk to do it. And so those two things kind of even themselves out. But I think that the reason that is because the market orders end up having so much power, Oh, you're saying that they're adding offers, huh? Oh, okay. Because what I'm seeing is every time that it ticks, they almost always pull. Well, okay, they're not doing it at 04 half there. So that's because that price hasn't traded recently yet, though. Those market makers probably want the fills. See, the big question is going to be if we get up into this 05 half, 06 area, like how much do they start absorbing? So you know what the really crazy thing here is? The net change in cumulative delta for the whole session is only 12,000 long. So yeah. I don't know. You would have thought, given how significant this news is and how much trade we've seen and how much volume we've seen, that the change in cumulative delta would be significantly higher, right? But it's not. Okay, so 1519 at 05, that's important, right? Because what it says to me is that the liquidity that we had above us has healed and is added back in, and that you are going to have some decent amount of market orders to push through some of these prices. Now they could come back and attack it again, but you can already see it reacting to that, right? Hmm. And was it more aggressive in the 30 there? I don't know. That's curious. That's curious. I think that it'd be very, very difficult to convince me to take anything short here. I am in buy all the things mode. Doesn't matter what it is. Gold, buy it. Equities, buy it. 10-year treasuries, buy it. Well, maybe this might not be the best spot to buy it in the 10-year treasury. I don't know. They kind of came back into the upper end of the distribution zone and did not perform very well to my satisfaction at 05. And there was a big trade at 02, so that's a similar sort of an issue. We just had just as much absorb on the bid side here. Well, and I don't see anything like correlated moving along with it either. So that was just a really odd move. You wish you had a trading job? Well, you're still fairly young. You could maybe still go get one. Go to Harvard. Go into finance. Maybe not. Sounds like a lot of work. Hmm. Okay. Well, it may be possible that we could sweep back across this range back up to 05 easily, but as of yet, they're not doing it. As of yet, they kind of back to 02 and they're kind of chill about it. Oh, look at that big. I didn't catch that there was a huge iceberg offer in the 5-year. That maybe would be more explanatory as to why we moved like that. Was that there was this huge iceberg in the 5-year and they doesn't look like they breached it. If they do breach, like that might be a good reason for them to come back up to 26.5 though. And then if they do bust it, giddy up. Okay, well, it reset. Let's see. It's pulling like crazy pulling. Okay. Being pretty flaky right here. You're not really getting too many takers there at 26.5. They remember what happened, I guess. Okay, back up to it. Okay, so they were able to make 26.5 go bid pretty easily. So that kind of says that the iceberg is not a problem anymore. I am seeing some of these others still, the 10-year and the 30-year, still kind of holding back a little bit, and or like the 10-year actually looks like it's trying to drag down here, right? But that's probably because of the steepening. So White House says it will continue to take steps to address rising inflation. Yeah, okay. Do you see how the White House has done a pretty coordinated PR strategy trying to address inflation today? Joe Biden had a press conference today. Janet Yellen had a press conference today. They've been tweeting a ton. Well, they did make 26.5 go bid, but it was just like the buyers didn't like that and gave up, I guess. Let's see here. Early market on close imbalance, 159 billion buy side imbalance. Well, yeah, so notice, well, I wonder are we getting flattening? Why is the 30-year? The 30-year is holding there at 140.002, and the 5 and the 10 fell. Yeah. Well, I guess he dragged him down. Unfortunately, because we came through there so quickly, this area between 119 and 04 is still pretty soft. 955, that's not too bad though. Wow. Okay. The S&P 500 is on track for a more than 2.25% gain on the day. The Fed hiked interest rates, and they hiked it 50 basis points too, mind you. That has only happened one other time in 40 years, and it was March 21st, 2000. Jeez. Good. Whoa. That's pretty whoa. Well, I don't know, guys. Still kind of not cooperating with me. Seems the volume is kind of dying out as well after that move down. We could pick up again, I guess, if we move back up, but so check out the videos on the channel. I have some really good videos, if I do say so myself. Particularly my videos about market microstructure and the inelastic market. So I'm really teaching you guys some stuff on this channel that is like quantitative market microstructure research that you're not really hearing anywhere else in the retail world. That is really valuable information. So I would definitely go and check those videos out. But you know, part of the thing here with trading is that it's hard. You're likely to lose money. Darn it. So it's back to this 119 even thing where we kind of failed catastrophically before. You remember that? You think that it'll hold this time? Let's see here. I haven't gotten the market on close number yet. Oh, maybe we need to be here on Financial Juice. Never turned it back
Market
on.
on close imbalance sitting at 2.1 billion to the buy side.
Okay, 2.1 billion to the buy side in ES. So I think that I can take the rest off here at 4,300. Be a nice even price to do it. Or should we say, no, I don't know if we could get 5,000. Well, we might. 4,307 is possible. With 2.1 billion, it's possible.
So after testing positive for COVID-19, Blinken will delay his key China speech set for tomorrow. This is according to US's price.
Disappointing. So we need to think now, what's ahead of us? Well, we got the unemployment numbers tomorrow. Man. Well, the pullback in the 5-year is not so dramatic. I think that what's happening is that the 10 and the 30 just are falling back harder because it's a steepener. Is what's happening. You're attacking the flank. Yeah, well. Yeah, the thing is like the sell volume was not that much. The bids just did not really hold up very well at all. And that has a lot to do with the liquidity in this situation, right? That's really this liquidity all through this area on the bid side is just a little bit weak. Just hasn't been long enough, for them to work it out. Like people want to buy overall, sure, but probably they already bought it. Okay, so there's my fills in ES. So now let's worry about these other two here. I'm interested to see how this reacts if the 5-year does come up and break a new swing high at 112.27. Because it kind of looks like it's headed there. Nope. Okay. And the 30-year came along that one. So there they are at 26.5. Again. This must be I don't. Nah. The amount of contracts that are trading here is really not that much. Like when I'm watching this here in the Treasury, like at least 1,000. I'm for me to really make too much note of it, it needs to be at least 1,000. When it ticks several ticks, with less than, a few hundred contracts being traded for it to do it. I'm over here looking, okay, is the Japanese yen doing something? Is the dollar doing something? Well, the dollar's ranging around, but I can't really explain that one. It's just the Treasury's doing it. It seems to me that the only reasonable explanation for the behavior that we're seeing here right now is just that the buy side liquidity is really squishy. So these guys up here, they could be, for all we know, selling to take profits because they want to close their positions out, That could be what's creating this behavior. Because it really wasn't, well, there was the big iceberg at 26.5 that kind of stopped us the first time. That was the only one that was really like that. And the other thing is when you look at like the market orders, because remember we said that in this kind of situation, the market orders tend to be more predictive. Well, the market orders in the 10-year is kind of going sideways. It's going kind of sideways. And I would say that it's doing that to some extent in the 5-year as well. So it's just diffusing through this area. The liquidity is just really light. Oh, that's a really weird looking chart, dude. And 30-year came back down there again really hard. Hmm. You see how soft that bid is. It only took 155 to go offer again. Okay, 121 up. Let's see, the 5 didn't. A little bit more. Ah, that's interesting. Okay, maybe now some buy orders are coming back in because that was 1,000 contracts that they just took there at 119 even. And that bid in the 5-year is getting looking a little bit more confident. Granted, they still have to break out on the other side, so I don't know. What was the last pivot up there? It was 0.2 in the 10-year. That's still like 4 ticks away. And while that was some decent volume on the buy side, let's not get too excited. It was only 1,000. We'd still need to see a lot more come through. So watch the S&P 500 here on the close, because the S&P 500 on the close is going to be crazy. Right? Okay, still seeing some. Okay. Oh, yeah. Look at that. 5-year busted through there really well. And the others definitely reacted to that. Now, this action may just be happening here because the S&P 500 is going to close, and these guys want to close some of their trades too, but oh my. Ooh.
At 4:10 p.m. Eastern Time, we do have the RBN,
that.
Parliament Select Committee Financial Stability Report.
Okay, so where does that leave us? Still stuck the higher end of this range, 04.5. And actually still seeing some relatively aggressive volume in the Treasury both directions here. So that's really weird to me. Okay, there's a big order showing up here in the 5-year at 27. Think they can get through it? Think it'll stay there? Hmm. Come on now. You can do it. We believe in you, 5-year. Oh, Gunlock is on CNBC right now, eh? Come on, I just want to see like a really clear line in the sand just get violated and see a huge cast. Oh, okay. It looks like that whoever had that offer there at 27 took it off. Boo. You know, this is, you know, what's happening here is I'm falling victim to like my expectations being raised again, right? We just had all that crazy action. So I'm like, yeah, let's do something. Okay, now we're after the market close, right? Should I really be expecting to see something super spectacular? Probably not. But I mean, it's possible. There's a big order there at 27. It can happen. It can happen. There's a little bit more there at 26 3/4 now as well. So who knows? And the 30 is not ticking up there neither. So let's name the stream here most dovish rate hike in history. Seriously. This is going to be one to remember, man. One of these days you're going to be talking to your kids, you know, like in the great bull market of 2050 or whatever, okay? Kids are going to be talking. Then there's like going to be a Fed meeting come up and you know, they're expecting rates to rise or whatever. And they're like, oh man, I should go short because if they're going to raise rates, then the market is just going to fall apart here. And then you can talk about that one time in 2022 of May of 2022, where the Federal Reserve raised 50 basis points and the market rallied because their statements were so dovish. And the market was overly bearish about rate hiking. You heard it first here. Big bull run 2050, y'all, right? I'm sure that there are many great bull markets ahead of us, my friends. I mean, this whole Russia thing and supply constraints has really hampered the economy, but I think that the bigger picture, things still look really good, in my opinion. And this market has been rough, but with my real money, I have been putting it on. I have been putting real money on. So been contributing more into my retirement accounts and stuff this month. So now, don't get me wrong. If the market like falls apart here, you'd be like, you were wrong, Seth. Well, it wouldn't surprise me if this volatility continued through the summer. But I think that by 2023, 2024, that you'll be saying to yourself, why didn't I buy more? Why didn't I buy more? Kind of like I've been asking myself through most of the session today.
Parliament Select Committee.
When I could have been short the yields at 3%. Why didn't I? Well, I'm going to scratch this because it is time to go. Watch, I'm going to get out. I'm going to get out, and then it's going to go and it's going to bust those highs, and it's just going to continue up, and then it's going to be like a month-long bull rally into treasuries. And oh my gosh, did somebody with 100 lots really just skip in front of me? Fuck you, dude. Come on. Yes.
So the US State Department
crap.
equally for mutual returns compliance with the.
Well, hey, at least I'm the first in line.
There is not an agreement.
At least I'm first in. It was you, Tommy. Damn it, Pom. it's Pommy Tane. That's what I almost said there. You know what? I'm having an off day. I'm tired. But I gotta get going. Well, I'm just gonna let it sit there and sort itself out. I'm sure it'll sort itself out, but I've got to get going. So I will see you guys tomorrow, bright and early, for the jobless claims report. In the meantime, stay profitable.